Hi, everyone. This is Adam Grossman. I'm joined today by Cullen Roche. Cullen is the founder and CIO of Discipline Funds in San Diego. Cullen was one of the first finance bloggers getting started back in 2008, a nice quiet year in the markets. Cullen's first book was titled Pragmatic Capitalism. And earlier this month, he released a new book titled Your Perfect Portfolio. Welcome, Cullen.
Hey, Adam. Great to be talking with you.
The title of your book is Your Perfect Portfolio.
I was very intentional about saying your perfect portfolio because I think the industry, especially, we sell a lot of different strategies and there are a lot of different model portfolios. And in the course of my career, I've always built model portfolios to try to streamline my own business and make it easier just to manage lots and lots of different portfolios. And it's funny because what I've always realized over time is that everyone's portfolio ends up being pretty different from the other one. So even if you build out a baseline sort of model portfolio, you go in, you actually do the financial planning work for somebody, and then you put the portfolio together, and it ends up being fairly different than the model even is, because that's how life works. Everyone's different, everyone's unique, and everyone requires a little bit of customization. But I've realized that you can't jam a square peg into a round hole with this process, and that's especially with a financial advisor, it's a collaborative process where you have to figure out a portfolio that works not only for the financial advisor's business, but also that's going to work for the client. And so I wrote this book with the intent of really studying lots of different strategies and styles. And the goal is to help people not only understand all of the different options out there, but hopefully arrive at a point where they can look at certain styles or strategies and say, hey, this really fits me well. This is something that I could do, that I could maybe customize inside of my own portfolio and utilize. And that will create my perfect portfolio, the portfolio that's perfect for me and not necessarily somebody else. And so it can be utilized in a way where its main goal is really to help people find the customized portfolio for themselves.
What I found very interesting was that you start the book with 10 essential principles. So they're almost like universal guidelines.
Mhm.
And my understanding of it was that you're saying, yes, there are lots of options, and you look at about 20 different portfolios, but you're also saying it's not anything goes. And so you lay out those principles. I wonder if you could talk about some of the most important essential principles.
Yeah, I went into the portfolio picking process with a strict criteria for why did I pick all of these different strategies? Why did I pick, for example, 60/40 versus something different? Or why did I decide to study the risk parity portfolio? And there are certain underlying characteristics that I think fit the building blocks for understanding why these portfolios are all considered good portfolios. And but I also tried to emphasize that when you go into this whole process, you have to go into it with the right mindset. And you have to have, I try to emphasize that you need to have a process going into this, because if you just pick a portfolio and you don't have a structure around how you're doing it or why you're doing it, you're going to abandon it in all likelihood in the future. And so the 10 essential principles explain, just so people understand, the book is broken up basically into two parts. Part one is the essential principles, and you can actually you can gloss over that whole section if it's not interesting to you. And then part two is basically a case study of 20 plus different strategies and styles. And I go into great detail on the history behind the portfolios and why they're popular, maybe their origin story. And then I describe the history of how they've performed and the pros and cons and who these portfolios might be good and bad for. But the essential principles part is the building blocks for understanding why these are good portfolios. And I think my favorite one was actually one that overlapped with my first book, Pragmatic Capitalism, because when I was writing that book, and I very specifically write, you're a saver, not an investor. And the reason why I make this distinction is because it's funny, in the world of finance and economics, the word investment has two very different meanings. In the world of economics, it means to spend for future production. And so firms, when they invest with, let's say they're building a factory or something, they are spending some of their capital to hopefully generate future production through building a factory or something like that. And what's interesting is that in the world of finance, investment basically just means to allocate assets with the intent of future returns, basically. And that process is very different than what a firm is doing when they spend for investment. When you buy stocks and bonds, you're quite literally not spending capital for future production necessarily. You are allocating some of your savings into an instrument whose value is actually reflected by the way the underlying firm spends for investment. And so it's very different. To make a bad analogy with horse racing, it's the difference between being the person who actually trains the horses and raises the horses and actually spends money on building the characteristics that will make a racehorse fast versus being the person who's just buying a ticket, whose value, a gambling ticket, whose value ultimately reflects how the horse runs. These are two totally different things. And so I like being very clear about this because I try to communicate to people that this is not some sort of get rich quick endeavor. I think a lot of people get into investing thinking like, oh, I'm just going to make as much money as I possibly can as fast as I can. And you see this a lot more recently, especially with the sort of, especially the gambling type of mentality. And there's lots of different newly issued instruments that really feed on the short-termism of people and the desire to gamble and try to make as much money as possible really quickly. You see this with there's a billion new leveraged ETFs every day and whatnot. And so I try to be very clear with people. When you're allocating money into a portfolio, you need to be thinking of it in terms of allocating your savings, because saving is a totally different, I think, psychological process than what some people think of as the sexy get rich quick investing style of a lot of different strategies. And so they're all portfolios that are designed to be used inside of the process of allocating your savings with the goal of, we have a plan in place and a process, and we're trying to achieve certain goals that are not just solely based on how much money can I make as quickly as possible.
You talk about one of the principles is beating the market is hard. You say it's very hard.
Yeah.
And I wonder if you can comment about that, especially in light of Warren Buffett's career. He just retired at age 95, and he did beat the market over time. But I wonder if that somehow relates to what you're talking about saving as a passive investor
Yeah.
versus investing and maybe having control over the result.
Yeah. So the numbers are daunting in these studies. That over 20 years, 95% of active investors will underperform a simple index. Of course, there's going to be 5% of people like Warren Buffett who they will beat the index over long periods of time, but it's the probability of being able to beat the market is just very low. And the other thing I'd like to emphasize in all this is that the reason I talk about savings portfolios versus investment portfolios is because beating the market is literally not a good financial goal. If you walked into a financial planner's office and you sat down and you went through the whole process with them, a good financial planner will never say our primary goal is to beat the market. And of course, everybody would like to beat the market. Everybody wants to generate the highest returns with the lowest amount of risk. And so that's fine and all, but that should not be a primary goal, in large part because typically when people are chasing returns, they're really chasing risk. And that creates, especially for a financial planning process, that creates all sorts of potential hurdles that you're going to encounter down the line. And so, yeah, the Buffett chapter was especially interesting because I read an entire chapter about the Warren Buffett strategy. And I think one of the most interesting things about studying the Buffett strategy and his history was that it's not actually the stock picking, I think, that really was the big multiplier in his process. The real secret sauce, I think, in the Buffett strategy was the structure of the entities that he ultimately ran over time. And so the primary one being the way that Buffett gets like an inherent sort of, or an implicit leverage in his portfolio because of the way that he starts buying these insurance companies back in the 50s. And these insurance companies are paying premiums and they're essentially like interest-free loans into the Berkshire portfolio. And Buffett's doing something very unique where then he's taking these cash flows and he's investing them in not only public markets, but Buffett was also a huge private market investor. And you could argue that it was actually the very early days of Buffett Partners, for instance, looked dramatically different than the later days in the Berkshire that kind of became famous. And everyone knows him for his public equity market portfolio. But back in the 50s and 60s, Buffett Partners was comprised largely of private investments to a large degree. And so it was the structure and the way he was doing things in a very sort of differentiated way at that time that made Buffett ultimately very successful. And I would argue in a lot of ways, Buffett was doing a lot of things that actually looked a lot more like investing than just saving, in the sense that, for instance, Buffett was very active with a lot of his early investments, where he was almost more like an activist hedge fund manager in a lot of ways, taking very concentrated positions. And then he was having direct influence on the business as well. Like, a lot of people don't know that young Warren Buffett was pretty cutthroat. He would go in and he would fire CEOs, and he looked almost more like a Gordon Gekko than the kind of happy-go-lucky guy we think of from Nebraska. And so that whole process is a very different process than what your average investor is going through. And so I think that that's a big lesson, a good takeaway to remember in all of this, that the ability to replicate exactly what Buffett did is just incredibly hard, because you're not just replicating a simple stock picking strategy. What you're really trying to replicate is an activist hedge fund style strategy that took very concentrated risks. And it's interesting, a couple of blowups and nobody would know who Warren Buffett is back then. And there was a lot of skill, obviously, over the course of his whole career, a lot of luck as well. And that's typically where that 5% of active investors end up being well known from, is to a large degree, they all experience a pretty significant amount of luck along the way that coincides with, obviously, a lot of skill as well.
A very important message. I wonder if we could talk about one other of your essential principles. You talk about asset allocation being a temporal conundrum.
Yeah, I really like to emphasize the way that we talk about asset allocation and diversification across different asset classes, but people don't oftentimes talk about diversification across different time horizons. And especially from a financial planning perspective, I think that the difficulty of financial planning is really, it's a time problem. When you sit down with somebody and you start mapping out their financial life and their different goals, you're really trying to make sure that people have enough money at certain times in their life. And Ken French said that risk is uncertainty of future consumption, which I think is a perfect way of summarizing all of the ways that we measure risk in the industry, whether it's behavioral biases or standard deviation, or Morgan Housel says that risk is what we don't know. When you think of it in terms of risk of future consumption, you can take all these things and jam them all down into one concept, where you can think about things across your lifetime and how and when you're going to consume certain things. So, for instance, if you're someone who is saving for a house down payment, maybe you've got a 2 or 3 year time horizon on that. That's a very distinctly different looking asset allocation inside of that piece of your portfolio than something like if you're planning for retirement. If you're planning for retirement in, say 20, 30, 40 years, that piece of your portfolio should look completely different than the house down payment part of your portfolio. And this is the thing we're grappling with. We're all here for a finite amount of time. We all have to consume certain things across different time horizons. And we have to allocate our assets in a way where the assets are hopefully in a stable enough position across all these different time horizons where you have certainty of consumption. And so asset allocation to me is really, it's a time-based problem, that if you're not planning for things across very specific time horizons, you maybe don't have certainty of future consumption, which increases the risks in your portfolio.
That's a good segue to the second part of your book, where you talk about the 20 different portfolio options. And I wonder if we could start maybe with the simplest one. So you talk about 100% bonds. You refer to as T-bill and chill.
Mm-hmm.
And that sounds safe, but how should investors think about that?
Yeah, so I'm probably a little too hypercritical of things like high yield savings accounts and CDs. They're not the worst things in the world, but I'm critical of them in large part because, God, I think they're fairly misleading. First of all, calling something a high yield savings account typically is an account issued by a bank. The bank is probably buying T-bills or something very close to T-bills, and then they're giving you typically a cut of the action. So if a bank issues a high yield savings account and gives you access to it, what they're really doing is they probably are supporting the asset with a T-bill matched portfolio in the underlying. And if the T-bills are yielding 3.5%, they're offering you 3.3% or something like that. But the worst part is they can't pass along the tax benefit. So they're owning the T-bills, they're getting the tax benefit, and then they're actually passing on or building that inside of an instrument that actually, after taxes and fees and everything, is actually a far worse instrument. It's so they call it a high yield savings account, which hilariously is not even close to being as high yielding as something like T-bills. And T-bills are just, they're the least risky, simplest instrument in the whole world. So from the bank's perspective, this is like the best risk adjusted return they can possibly get, is selling people a high yield savings account. So I'm as someone who's very hands-on with money, obviously, I'm hyper active with cash and very hands-off with stocks, which I think is the opposite of the way most people treat this. But I try to emphasize that, hey, don't buy the CDs or the high yield savings accounts, or even there are some money market funds out there that are high fee, that are terrible, that own a lot of money market funds, own just corporate bonds, actually. So commercial paper and things like that, that these things have no tax benefit to you. I like to emphasize that, hey, there's an easy way to do this. Yeah, it can be complex. You can make it messy. Like Treasury Direct is popular. I hate Treasury Direct. So, and I know that rolling T-bill ladders is probably not something that your average person wants to do. They don't want to feel like they have a second job, but there are lots of ETFs out there that are super low cost. There's even some really innovative ones. The box ETF from Alpha Architect is one that I talk about a lot, that this actually enhances, it has a multiplier effect in the tax efficiency, because what they're doing is they build like a synthetic T-bill instrument, basically. And if you hold it for over 12 months, it turns ordinary income into long-term capital gains, basically, where you can, with optionality, you can start to distribute parts of the portfolio down to service your short-term consumption needs. But so that's like the most boring one, but it's also arguably one of the most important ones, because I would argue that people largely mismanage their cash, whether they just leave way too much cash in a bank account, or they're utilizing instruments inside of a cash equivalent like account that actually are not high yield, that are not actually really giving you the full benefit of really risk-free instruments.
You talk about asset allocation being a temporal challenge. And I wonder, what if someone came to you and said, I'm 65 years old, I'm retiring tomorrow. What if I just build a 30-year ladder of treasury securities? How would you think about that? What are the pros and cons of that approach?
Oh gosh, I this is another thing. I'm a huge advocate of very short-term instruments. I'm somewhat hypercritical of very long duration bonds. My general view is that, so first of all, I love the concept of tips ladders or bond ladders. Matching, anyone who is matching assets to liabilities is really, they're really speaking my language in a lot of different ways, because that's really my wheelhouse, I would argue. And that comes from my influence with banks back after the financial crisis. I learned how banks work, and I started thinking, hey, this portfolio management style of asset liability matching is actually much more applicable to your average retail investor than it is for a bank. And so I try to be pretty rigorous about matching assets and liabilities inside of portfolios. But I do think that you get to a point where you don't need, I think a lot of tips ladder advocates would say that, hey, I want to match my 30-year liabilities to an instrument that has a 100% chance of having a real return over that time horizon. And I would just say that when you start getting into certain longer duration time horizons, I think government bonds, especially, they're just, they're not very good liability matching instruments, because it depends on the time horizon or the environment we're in. If we were talking in the 80s or 90s, I might have told you something very different, because interest rates were wildly different compared to interest rate risk. But right now in this environment, like a 30-year treasury bond is yielding what, 4.5%, and has a duration or an interest rate volatility level of 18%. And so what that means basically is that if interest rates move by 1% up or down, you're only getting 4.5% yield, but you're getting 17% of volatility, 17, 18% of volatility in that instrument along the way. So these are wildly volatile instruments that on a risk adjusted basis, they just don't generate very good returns. And so the kicker with this is that my view basically is if you've got a 15 plus year time horizon, really, the probability of the stock market outperforming the 20 or 30 year bond is just, it's very high. It's not 100%. So I understand for the people who they want to have that 100% guarantee of owning the tips ladder. They just want to sleep well at night. They don't care about the returns of the stock market or whatnot. I totally understand it. But I would say from the vast majority of people, if you've got that sort of runway in your portfolio, you should be diversifying outside of the bond market. You should be matching assets actually to the stock market to a large degree, or even, gosh, I would argue, like in my methodology, which I call defined duration investing, we actually quantify the time horizon of different instruments. And I would quantify like even a 60-40 portfolio comes out to, like, right now it's like a 13, 14-year instrument. And I would argue that even that sort of an instrument has a much higher probability of outperforming bonds over rolling 13-year periods, where you can virtually eliminate sequence of return risk inside of these things, because the returns are likely to be high enough that over the course of a rolling 15, 20-year period, the probability of that thing creating a lot of sequence risk inside of your portfolio, it just drops dramatically, because the stock market outperforms bonds 95% of the time over rolling 20-year periods. And there are anomalies where it doesn't. But I do think in general, people should not match long duration bonds to long duration assets.
Great. So that brings us to another of the portfolios. So at the absolute other end of the spectrum, you have 100% stocks. So what if someone were 30 or 40 years old and said, I have a few decades until retirement? Should that person go all in 100% stocks?
Yeah, potentially. And it depends, of course. This chapter is a play on a famous Cliff Asness paper where he titled it, Why Not 100% Stocks? And he criticizes the arguments for 100% stocks. It's become, especially, there was a popular paper a couple of years ago that came out that actually argued that investors should be 100% equities, that they don't need any diversification across cash or bonds, basically, because the stocks will outperform. And once you get into that kind of clear air where you get high enough principal returns, you have virtually eliminated sequence of return risk inside of that portfolio, or you've mitigated it to a large degree because of previous growth. But it depends. One thing I try to emphasize in the book is that you should think of your human capital as a fixed income allocation. And what I mean by that is that the income you're generating from your job, it functions a lot like a bond. And so if you're making $100,000 a year, you can think of that as you have $1 million bond that is paying, say, 10%, or a $2 million bond paying 5% or whatever. And you've got this, it's an explicit fixed income, literally, for you, that's coming from the asset that is your human capital, basically. And so that's the argument, in part, that as someone who's 20 years old, who's got 40 years of runway before they're going to start dipping into their portfolio potentially, they actually have a lot more potential to take equity market risk, because they've got a bond. They've got basically a 40-year bond that is going to be paying them 10% a year. It's arguably, that's the greatest asset that person has in all likelihood. And so they've got a much higher risk capacity because of that. And it's the tricky thing that happens for a lot of people as they near retirement. And I see this front and center in my day job every single day, that people really struggle with retirement, not because they just are running out of time necessarily. It's mainly that their income is going to go away. That fixed income piece of the portfolio, one day it just goes away, or it shrinks very significantly down to whatever Social Security is or whatever other income sources they might have in retirement. And that's a huge psychological hurdle. A lot of people, I don't think they explicitly think of it like that, that they've actually reallocated their portfolio away from bonds, much heavier into probably stocks or something else. But that's really what's happening to that person. And psychologically, people know that transition is really hard, because they suddenly start to internalize a lot of the increased risk that they experience. But so it depends. I like to try to break it up by different portfolio type too. A 50-year-old with a Roth IRA and a traditional IRA and a taxable account, their Roth IRA has probably a very different return and risk profile than their taxable account does, where they've got the luxury in the Roth IRA of probably thinking of that account as maybe it's a multi-generational account. It might be the kid's account. Maybe the kid's risk profile is actually the thing that dictates that asset allocation. And so that portfolio, or that piece of your portfolio, that thing might be 100% stocks. And maybe that's where you're putting it's the full gas, pedal to the metal. You own tech stocks and growth stocks, and because it's got just a totally different time horizon than, say, the taxable account. Where the taxable account, if you're 50 or 60 years old, it probably reflects something that looks more like a target date fund or a 60/40, where you're now starting to think of a more balance. You've made a lot of money and you're starting to think about that portfolio in a different sense, where maybe it's going to have to start funding some consumption needs in the short term. And so it requires a totally different asset allocation.
That's a really key takeaway, that it's not just that there's a perfect portfolio for each person, but any given person might have a perfect portfolio that applies to each of their different types of accounts.
Yeah, totally. And
Um,
I
yeah,
think that's a really useful way to think about all of this, that you're not just building one sort of homogeneous portfolio that has is solving multiple needs across different accounts. I really like to structure things in different accounts with the specific intent of understanding, okay, my Roth IRA is actually serving a totally different financial need than my health savings account is, for instance, or something like that. And so the asset allocation inside of all these different accounts could be very different, and they each one has to be its own perfect portfolio. Where maybe you're doing, maybe T-bill and chill is the health savings account, and maybe 60/40 gets applied to your taxable account. Maybe the Boglehead 3 fund portfolio is your traditional IRA, and then maybe the 100% stock portfolio is your Roth IRA or something like that. So you can pick and choose and have lots of different perfect portfolios of your own.
you mentioned the 60/40, and there's the Boglehead 3 fund portfolio. Do you feel like those are good happy mediums? What are the pros and cons of those?
They're really they're the portfolios that are probably the simplest diversified portfolios. And I think that's the reason why the Boglehead 3 fund portfolio is so popular, I think, is because it's incredibly diversified, but it's incredibly simple. I interviewed Taylor Larimore for the book, and Taylor was really interesting because I think what Taylor ultimately decided to do was he created this portfolio because he distilled all of John Bogle's essential principles down into the cleanest, neatest little package possible. And so the 3 fund portfolio, for people who don't know, it's basically a bond aggregate fund, a domestic stock fund, and a foreign stock fund. And it's just 3 funds that can be bought for, gosh, close to 0% fees at this point through the ETFs and Vanguard funds, or whatever, however you decide to do it. But it's just it's really elegant in its simplicity. And so those are the 60/40 and the Boglehead portfolio they've stood the test of time because they're diversified portfolios they own thousands of different underlying instruments, but they cut out almost all the middlemen in terms of the high fees that we often see in a lot of ETFs or other things that can be harmful to long-term returns. And so they're the simplest, but I think they're also two of the most popular because they're that fine line between something that is complex and yet really simple at the same time. But you can also argue that there are elements, like I'm a little bit critical of the 3 fund portfolio because I would argue that there's an element of it that is too simple. Like you don't have a cash bucket in that account. So if you're going through 2022 and you were a retiree with the 3 fund portfolio, you maybe didn't feel that comfortable. You probably felt like you wanted a fourth bucket inside of that portfolio at times during that year. And I think you can nitpick at those sorts of strategies and say, maybe we needed another bucket with a different time horizon or something. Or maybe there's a lot of people that after the bond bear market of 2022, they'll look at bonds and they'll say, I'm adding a trend following component, or I'm adding an alternative sleeve or something. And that's a personal argument that I think is valid, but it depends. Again, it depends on the person and what your perfect portfolio has to look like for you.
The 60/40 has been the default for decades, but it always seems to be opened up for criticism. 5 years ago, when interest rates were really low, people were talking about how the bond side of it was deficient. And now I think Vanguard this week issued a paper where they talked about how they have a downbeat expectation for US stocks over the
Yeah.
coming decade. And so I'm curious, to what extent should people be rethinking their strategy even after you go through the exercise of deciding, okay, what's my perfect portfolio? How often should people be revisiting their strategy?
Oh gosh, that's a life changes. That's the big thing is that you probably can't just put together a 60/40 and expect it to service all of your needs across all different time horizons because things are going to change. And maybe when you were younger, you should have been more aggressive. And maybe when you're older, you might be inclined to be a little less aggressive than a 60/40 or something like that. But yeah, it's interesting because I think that the process of building this is so personalized that people really they have to figure out what's going to work for them, and how much they're going to change is really a factor of how much their financial plan changes over time. I think that from a personal perspective, am I'm probably much closer to a set it and forget it type portfolio manager for the most part, especially like I mentioned, I'm very hands off with equities for the most part. I think for those longer duration instruments, especially, those are components of the portfolio that I don't think you should tinker with too much. You should probably just buy index funds and set it and forget it, let them serve long term needs, and don't get the urge to tinker with it. But at the same time, it's tricky because a lot of people, like I work with some people who I'll manage 95% of their portfolio, and they say, you know what? I want to pick stocks with the other 5%. And it keeps me interested. I know I'm not supposed to do this. And I'm typically like, sure, that's fine. If that 5% that you're just scratching an itch with is actually helping you maintain the other 95% of the portfolio and stick with the strategy, then you could argue that 5% piece is like the most important part of the whole plan. It's different. Everyone's different. And that's the main thrust of the book.
Your view is that you should revisit your strategy only in response to changes in your own life and not necessarily in response to some market commentator issuing a forecast?
Yeah, that's really, especially because the financial media they're so incentivized to say almost hyperbolic things all the time because they're just trying to get your attention. And that's counterproductive to a lot of what good, sound portfolio management requires is that you need to be impervious and really behaviorally robust against a lot of the narratives in the media because they're always trying to latch onto your fear. And I think that you also just need to be mindful of things like I try not to be really active inside of a 365-day time horizon because I'm very conscientious. And so you want to be like, that's a common question is how often do you rebalance or how should you rebalance? And it's different. It's different. In general, I think you should be mindful of the tax ramifications. So you probably shouldn't rebalance inside of a calendar year. But also, it's interesting because like one of the chapters I wrote about was the countercyclical rebalancing strategy, which weirdly is a strategy that I created but derived from John Bogle. And Bogle is thought of as like the king of passive investing, but Bogle was actually very active with his portfolio at times. And so this is
Hmm.
another element of this that's really important is that a lot of this is behavioral based. And so what Bogle did that he discussed back in the like 1999 was Bogle had a 70/30 portfolio back then. And he looked at valuations and he said, you know what? I am so uncomfortable with everything going on right now that I'm going to flip it. I'm going to flip the script to 30/70 right now. And he was looking at that from a behavioral perspective. He very specifically said he wasn't trying to beat the market. He wasn't trying to generate like better risk adjusted returns. He changed his portfolio because he thought that it would help him stay the course, as Bogle liked to say. And sometimes you have to make changes because, hey, if you're going to make a change that actually helps you keep the whole portfolio invested, that could be a beneficial change. And I like to try to emphasize doing that in the most tax efficient way possible where you are making changes like that. But it's something that I think the big trick to avoid in something like that is to avoid the sort of gambler's mentality where you're treating the portfolio like something where you move all in and all out. And I think that was the beauty of what Bogle did actually with the counter cyclical rebalancing approach was that he really was rebalancing his portfolio by changing the relative weightings rather than Bogle didn't say, I'm so scared. I'm going to move all to cash. I'm going to put everything in T-bills and wait this out. Because the problem with that is you've got to time the market twice. Not only do you have to time the exit correctly, but then you got to time an entry and you've got to have a process and a methodology for re-entry into the market, which those two, the odds of you timing both of those events correctly or even well is just very low. And you're going to find yourself in a position where You get out of the market in 1999, you move all to cash, you feel like a genius through 2022 or 2002, and then the bull market starts and you miss the bull market and you get back into the market in say 2006 or something, and then the GFC wallops you over the head. And that's the gambler's mentality, though. And so I like making changes in a portfolio where appropriate for valuations. And I can understand someone who, for instance, in today's environment, maybe people are looking at AI stocks and the US stock market in general, and they're saying, you know what? I am really uncomfortable with everything going on in the United States and the AI valuations, and they've had a great run. I'm going to take some money off the table there. I'm going to put it into value stocks or international stocks or whatever. I'm going to diversify into something a little bit different because I think that making that change will actually help me stay the course in the future. So it's difficult in part because a lot of this is so behavioral based.
Speaking of valuations, gold has had quite a run over the past year, but one of the big criticisms of it is that there is no real way to value it. It has no intrinsic value. So you
Yeah.
can't use like a traditional PE ratio to decide whether gold is high or low. Gold does make an appearance in some of the portfolios you talk about, like the permanent portfolio. And I wonder if you
Yeah.
could comment, how do you think about gold?
Gosh, it's a really tough asset to think about because gold is, like you said, it's an instrument that doesn't generate cash flows. There's no way to really value it. And the instrument itself is really just a commodity. And so it's strange to think about because it generates its returns largely from the way that the commodity has a price in the underlying. So the way I actually think about gold, though, is that gold has what I call like a faith put in it, that there's this other element of gold where people view gold as money. And so it's almost like fiat currency insurance in the way I think of it. And which I don't think is irrational, but at the same time, nobody knows what that premium should be worth relative to gold. And so I think it's a really hard one to analyze because you see it in environments like right now where gold is having this huge run up and people are assigning it to this debasement trade or something like that. Or there's, I'm sure, lots of different factors involved in why gold is doing what it's doing right now. But nobody knows how to value it. And so it almost creates, like I talk at points in the book about what I call inside of the temporal conundrum. I talk about what I call a price compression. And what I mean by that is that when an asset goes up a whole lot in a single year or in a very short time period, the way I like to think of it is that let's say that gold can be reasonably expected to generate 8% per year, for instance. And let's say it does 70% like it did last year. What happens, in my view, inside of an environment like that is that you've taken a whole bunch of those average 8% and you've compressed them all down into 1 year. And what this does is, in my view, it creates much greater sequence of return risk going forward, where the probability of the prices decompressing at some point to the point where, yeah, they might average 8% over the course of the next 30 years again, but you're going to have a huge amount of sequence risk there. And the classic example really is the NASDAQ bubble, where one of the interesting facts I always like to point out about the NASDAQ bubble is that if you bought the very tippy top of the NASDAQ 100 back in 2000, you've generated an 8% return per year, which is pretty incredible, like a really high return, a really good return. And you picked the absolute worst time to buy the NASDAQ 100. The kicker, of course, is that you went through 15 to 20 years of just horrific sequence of return risk inside of that portfolio, where you went through at least a 20-year real return bear market in that instrument. You had to be really patient with it. So that's when I see an asset booming like that, that's how I like to think of it. But the Harry Brown, the permanent portfolio, is really interesting because it has performed really well. It's actually one of the better risk-adjusted return portfolios that I talk about in the book. But it's a weird one for me to think about because I would argue, you only have 25% of the portfolio in stock. So just so people know, it's designed to be an all-weather portfolio. It's 25% basically T-bills, 25% long-term treasury bonds, 25% gold, and then 25% stocks. And I think you could look at that portfolio and criticize lots and lots of aspects of it. Like I would say that, again, going back to my criticism of T-bonds, I would say that nobody should own 25% of their portfolio in long duration bonds. And then 25% in cash is arguably way too much for most people. 25% equities is probably way too low for most people. And then how comfortable do you feel owning 25% of your portfolio in gold after a huge run like this? I don't know. And from a cash flow perspective, too, I don't think you can actually model that portfolio out into the future and assign reasonable expected returns based on some of the underlying uncertainty in the different components. But it's done really well, and it's a very diversified portfolio. And I love the underlying simplicity of the logic, where it's an all-weather portfolio in the sense that each component is solving for one of the seasonal problems that Harry Brown talks about, where the stock market solves for a growth environment, the gold component solves for an inflationary environment, the T-bond solve for a deflationary environment, and the cash is there for a recession-proof component, which is you're covering a lot of your different bases with that. So it's an intriguing portfolio in part because it is relatively simple, but also because it's got an underlying pretty compelling rationale.
Another portfolio that people talk about as an all-weather approach is the endowment model. And I think that approach has gotten a lot of discussion over the past year because of the potential for private funds to enter 401k plans.
Yeah.
I'm just curious, how should individual investors think about the endowment model?
This is a really hard one. I wrote this chapter and I struggled with whether or not I wanted to even present it, because endowments they're typically managed by teams of people. So they can be very complex, in large part because they're doing a little bit something that's almost more like an early Buffett partners portfolio, where they have a huge private equity component. Typically, they've increasingly moved from public equity components actually into private equity components. And so you could have a huge venture capital arm inside of this, and then you've got a public equity component, and then you've got typically endowments. They'll have at least a bond component that maybe is structured more like a bond ladder. So you've just got a lot of really sophisticated moving parts going on in there, where you almost need like your own research team to actually manage a good endowment portfolio, which is obviously not achievable by your average retail investors. Yeah, they're really complex. They're hard to replicate. You start getting into really like opaque structures, like a lot of the private equity funds I talk about they're somewhat opaque. They're not even going to reflect their underlying net asset values correctly all the time, because private markets they're so illiquid to a large degree that they're not able to actually mark to market in any reasonable way. And then you've got a huge fee compounding effect inside of a lot of these portfolios, where especially if you're outsourcing your private equity component to outside managers or something like that, or you're doing it through venture capital, you've got really high embedded fees inside of all this stuff. So for your average person, I mean, there's a handful of instruments that try to simplify this into one, like ETF or something. But I would say for the vast majority of people, you probably have no business trying to put together an endowment portfolio, and you probably really don't need to try to do anything that sophisticated in the first place, because there's other just really simple models, whether it's the 60/40 or even the Harry Brown or whatever it might be, where you can get really low cost, really diversified asset allocation without giving yourself brain damage trying to overcomplicate everything.
You mentioned your approach, which you've termed defined duration investing. You introduced this in a paper about 3 years ago. Could you say a little bit more about how that works?
Yeah, so this is a process where I'm really trying to solve the problem of time inside of somebody's portfolio. It's like a bucketing strategy, I guess you could say, where I'm bucketing things into very specific time horizons, but I'm doing it in a much more personalized way, where I might have 10 individual buckets inside of someone's portfolio, where each bucket is serving a specific financial goal and matched to a specific asset. So it's the thing that I always disliked about bucketing strategies was that they don't really quantify or communicate the time horizon to people. They use these vague sorts of terms where it's like short term, medium term, and long term or something like that. And the question I always run into is, what is long term? Tell me what long term is in the stock market. And so when I wrote the paper 3 years ago, I was really trying to quantify what is the time horizon of something like the stock market. And so I really was looking at this and saying, basically, my goal basically was to quantify something like the sequence of returns risk. And so if you could look at something like the stock market and you can make certain assumptions about expected future returns, a potential max drawdown, you can actually quantify, well, what is the potential sequence of return risk inside of the stock market at this given moment in history? And for instance, with the global stock market right now, it has an average defined duration, the way I quantify it, it's somewhere in the low 20s right now. So that's your potential sequence of return risk in real terms if the stock market were to fall 50%, for instance, from here. And so the stock market, when embedded into this model, you have to utilize it as it's a long-term instrument. But the other cool thing and the unique thing about quantifying this stuff is that I'm able to then blend different instruments together, because then you can take something like a T-bill, and if you blend a T-bill with the stock market and you have a 50-50 weight, for instance, a T-bill has a 0 defined duration, basically. If the stock market is 22, then the average defined duration of this instrument, if you blended them 50-50, would be like 11. And that is if you take a fund or something and you actually blend that into one instrument, that 11-year instrument is going to have a very significantly different sequence of returns over 11 years than the 22-year instrument will if you're just buying 100% stocks in a portfolio. And so you can actually blend all these different instruments. You can quantify what's the time horizon over which we have reasonable sequence of return risk inside of it. And then you can allocate it in a much more quantified sort of bucketing strategy where especially I'm always working with individuals and clients on this, and where I'm actually mapping out the expenses and liabilities for people. And I'm saying, okay, we need 1 year of emergency funds that's going into a T-bill ladder. We have a house down payment for $200K that we need to set aside. That's going into say a 3-year instrument. And then we've got kids are going to college in 10 years. We're going to match that to a 10-year instrument. And then you've got retirement goals 20 years out. We're matching that to 20-year type of instruments, 20 plus, whatever it might be. And so you can start to build a very rigorously temporally structured portfolio utilizing this methodology, where you're actually giving people, like, this has been the coolest thing for me about actually implementing this with real people, is you actually see the way that they understand this, because people understand time. They don't understand, your average person especially doesn't understand growth or mid cap or small cap or large cap or factor investing. And so they maybe they understand, okay, a growth fund is probably going to be something much more conservative or something in the long run, but you're not actually giving them a quantifiable metric to understand how does the growth fund actually apply to your portfolio. And for me, assigning the time horizon value to these different instruments, it creates a clarity for people that they interpret it and they understand it in a totally different way than they do when they just look at a diversified portfolio and they say, okay, I know I'm diversified. My financial planner said that I have a 95% probability of having enough money at retirement, and that's all well and good, but I really have no idea what the specific components of this portfolio are achieving for me, other than the fact that they appear to be diversified and whatnot. So this is my own process of trying to build a portfolio, where I came up with this kind of in the throes of COVID, because I had my first daughter back then. And my time horizon before I had kids was very simple. I had one time horizon, basically. It was me and my wife. And we were aggressive, and life is simple at that point. I'm going to be super aggressive, and I'm just planning for retirement. We're both working. Our human capital's generating that big fixed income component for us. So pedal to the metal, be really aggressive. Then the market crashes. I had my first daughter a few weeks before COVID hit. And when I woke up one morning and I was like, this is crazy. I need to think about life insurance, and I need to think about all these different time horizons. I need to think about how I'm going to pay for diapers and daycare and college. And kids introduce all these different other time horizons into your life that they require a lot of financial planning, basically. And so I started structuring this whole defined duration methodology, because I was really trying to solve my own temporal problems that I was having in my portfolio, where I needed more structure inside of the way I was doing this, where I could look at certain assets and I could say, all right, well, we're planning to move in 3 years, and I've got $300,000 of treasury bills sitting there just waiting, that are super low risk. I know for a fact that money's going to be there in 3 years. and assigning all these different time horizons and then matching very rigorously to specific assets that match those time horizons.
You refer to this as asset liability matching, which you said is a methodology that's borrowed from banks and insurance companies.
Yeah.
And I wonder if you can explain what happened. You talk about Silicon Valley Bank and what happened there and what the lesson is for individual investors.
Yeah, banks are really interesting. I worked with a lot of bankers after the financial crisis, and I learned from them very specifically how they think about their own trading portfolios and how they have to be very mindful of any asset liability mismatch in a portfolio because banks are typically they're entities that they borrow short and they lend long for the most part, and they've got deposit outflows that are going out every single day. And so they have to maintain a high liquidity ratio because they have to be very mindful of their ability to meet withdrawals. And so it's Silicon Valley Bank was a really interesting situation because what basically happened with them was they had a humongous asset liability mismatch where they owned way too many long duration assets. They didn't have the liquidity to meet their outflows when people came knocking. And so this asset liability mismatch resulted in them basically having to sell huge amounts of their long duration instruments to create liquidity, and it ruined them. And the interesting thing, though, is that I realized that when somebody is invested really heavily in the stock market, what they're really doing is they've got a huge long duration exposure inside of their portfolio. And when somebody gets scared and they sell some of their stocks in a bear market, what they're really doing is they're buying cash. They're buying a short duration instrument that gives them a lot of certainty in exchange for a long duration instrument that gives them a lot of uncertainty in the short term. And so the reason that people, I think, succumb to this behavioral bias of selling into bear markets is because they have a huge asset liability mismatch in their own portfolio. And they may not think of it like that, but that's what's going on in your mind is that you're realizing that, hey, I've got way too much long duration asset risk in my portfolio, and I need to throttle this back to create certainty. So I've got that certainty of consumption where whittle down this mismatch basically in my portfolio. And so it's interesting to me that the retail community gets sold on factor investing and styles and strategies. And meanwhile, banks and institutions and pension funds, they're out there doing asset liability matching. They don't care. They don't care necessarily about styles and factors. They care about, do I have enough T-bills in my portfolio to meet the liquidity needs of my outflows at certain times over the course of the next day, year, or decade? And so it's a totally different thought process. And I think it's a process that solves a lot more problems for a retail investor than it does necessarily for a bank, because I think that a lot of retail investors, heck, every retail investor has this problem of time in their portfolio. Some are simple, some are much more complex, but for the most part, I think that learning to think across very specific time horizons is just really useful because it creates this clarity of, okay, I know I have this amount of liabilities in the future, and if I'm matching assets to that, I'm mitigating a lot of the behavioral risk in my portfolio because I understand exactly what my asset liability mismatch looks like and if there is one or not.
In terms of the stock market and the importance of not having that mismatch, you talk about the stock market having maybe a 20-year duration. And I have to say, I found that a little unnerving because a lot of investors look at the stock market and they say, if you look at 2000 or you look at 2008, you were back to even within about 5 years, maybe 7 years. And so
Yeah.
that's the way they think about managing that risk. But what you're saying is, no, be careful. It could take longer. Is that the message?
I'm using a pretty conservative estimate inside of this because what I am really trying to quantify is that sequence of return risk where you have almost like not necessarily like a worst case scenario, but you have a very large and traumatic bear market at an inopportune time. And so you could argue, yeah, it's a little conservative maybe, but at the same time, and this is the other thing that's important inside of this, is that I'm using real returns. And so I did this throughout the book where I presented everything in inflation adjusted numbers. And some of the numbers that we hear, say the stock market does 10% per year, when you back out taxes, fees, and inflation, that return is probably closer to 3 or 4% for a lot of people. So the numbers, inflation It's interesting that in the financial services industry, we talk so much about the investment management fees, but it's actually the inflation and the taxes that are they're the real big dinger in that, detracting from the real or the gross return of the portfolio. But yeah, I talk about real returns very intentionally because I wanted to present all the data in an after inflation adjusted basis. And in terms of this model and the stock market being this 20 plus year type of instrument, the model is coming to that conclusion in part because inflation erodes your break even point by so much. So I don't know the number off the top of my head, but my guess is that even after a year like 2008, the real break even is probably, even though the nominal was probably 3 years or so, the real break even is probably closer to, I don't know, 5 to 10 years, I'm sure. So it, even in that environment, you broke even pretty quickly, but it is not remotely unusual to have the stock market go down in real terms and stay down, especially across global data, for decades at times. And we're seeing that actually right now in the bond market. The bond market still has not recovered from a real negative return since the downturn from 2022. Even that instrument, I try to emphasize, that's another thing, is that people talk about how bonds are safe instruments. An intermediate bond index or an aggregate bond fund, actually it's closer to a 5 to 7 year instrument at minimum, and which is a relatively long time to undergo a big negative real return and not break even. So even with an instrument as safe as a bond aggregate, you still have a pretty decent amount of principal risk that is, it could require some patience across different time horizons.
The book is Your Perfect Portfolio. It's available now. Thank you, Cullen.
Thank you, Adam. It was great talking with you.